Hello everyone and welcome back. So today we're going to talk about trading options. We're going to talk about what they are, we're going to talk about how they work, and we're going to talk about why you may want to consider adding them to your overall trading strategy. I'm also going to explain some of the terms that are used in trading options, so hopefully we'll demystify that for you. So let's talk about options. So let's start this video by explaining what options are and the type of options that are available. First of all, let's talk about the two main categories of options. There are American style options and there are European style options. Now this video is going to be basically only about American style options, and the reason for that is that any stock options that are traded on open marketplaces right now will be American style options, so you're almost never going to come across a European style option. The reason that I wanted to discuss that here is just for your overall knowledge. American style options may be exercised at any point during the life of the option up until the expiry date, whereas European style options can only be exercised at the expiry date. Okay, so now that we know we're talking about American style options, let's talk about the two main types of options, and those are call options and put options. So a call option is basically a contract that gives the buyer the right to buy a stock at a predetermined price known as the strike price. A put option, on the other hand, is basically the opposite of that. It is a contract that gives the buyer the right to sell a stock at a predetermined price known as a strike price. So call options are a bullish bet, and what that means is that when you buy a call option, you're hoping that the stock price is going to go well above your strike price before the expiry date. Put options, on the other hand, are a bearish bet, meaning that you're hoping that the stock price is going to go well below your strike price before the expiry date. It's worth mentioning that although options give you the right to buy or sell shares at your predetermined strike price, you don't actually have to buy or sell the shares to make money with options. You can simply sell the option before the expiry date once it's increased in value and never purchase or sell a share at all. We'll get into an example of how this works later in the video. If, however, you wait until the option expires and the current share price is above the strike price in the case of call options, or below the strike price in the case of put options, it will automatically exercise the option. This means for call options, it'll basically purchase the 100 shares at your strike price automatically. So you need to have that money in your account if you wait to the expiry date. If you don't want that to happen, then you need to sell the option before the expiry date. So let's talk about some of the common features of call and put options. First one is the strike price, and this is the price you specify that you want to be able to either buy at if it's a call option or sell at if it's a put option. The second feature is the expiry date, and this is the date obviously that the option will expire. So inherently options have an expiration date, and this is what makes them a little bit more risky than purchasing a stock outright. We'll discuss that a little bit more when we talk about the pros and cons of options trading. The last feature we're going to talk about is the premium, and this is the price you pay to actually purchase the option contract, and we'll go into more detail about how they arrive at that premium a little bit later in the video. It's very important to note that the premium is based on 100 shares of that stock. So if you're looking at the premium price, you need to multiply that by 100 to arrive at the price you're actually going to pay for one option. For example, if you're looking at a premium that's $5, you'll have to multiply it by 100 to get it $500 is what you're actually going to pay for that contract. So let's talk about some of the factors that affect the premium that you'll pay for an option contract. The first one's going to be how close the strike price is to the current stock price. And generally, the closer to the current stock price that the strike price is, the higher that you'll pay for that premium. The second factor is volatility, and this is one of the key factors for options trading. You want a stock that is very volatile. And the reason for that is because you're going to want the stock, if you're buying a call option, to go well above your strike price. Or if you're buying a put option, you're going to want it to go well below your strike price, and that's what gives the option its value. So the more volatile the stock is, the higher you're going to pay for that premium, and those volatility scores are all done by computer algorithm. And that's how they arrive at that volatility score, which comes into play for the premium. The third factor is how far into the future the expiry date is, and of course generally how the further into the future the expiry date is, the higher you're going to pay for the premium. So let's talk about what gives options their value, and that's based on two metrics. The first metric is called intrinsic value. In the case of call options, intrinsic value is the dollar amount the current stock price is above the option strike price. In the case of put options, intrinsic value is the dollar amount the current stock price is below the option strike price. For example, if your strike price on a call option is $300 and the current stock price is $305, the intrinsic value is $5. Now remember that options are based on 100 shares, so $5 in intrinsic value equals $500 in value when you go to sell the option. There are essentially three states that an option can be in. The first state is if the current stock price is below the strike price in the case of call options or above the strike price in the case of put options, the option is said to be out of the money and the intrinsic value is basically zero. The second state it can be in is if the current stock price is the same as the strike price, then the option is said to be at the money and the intrinsic value is still zero. The last state it can be in is if the current stock price is above the strike price in the case of call options or below the strike price in the case of put options. The option is said to be in the money and the intrinsic value is equal to the dollar amount above or below the strike price, as we mentioned earlier. The second metric that affects the option value is called time value. Essentially what that is the amount of time that remains before the option expires. So you can imagine that the closer to the expiry date you get, the less the time value will be. Although the value does not go down linearly, it's more of a curve. And I'll put on the screen right now what that would actually look like. You can see that if it's a long ways away from expiry date, it actually goes down quite gradually, but the closer you get to the expiry date, the more rapidly you lose that time value. So let's look at an example using a company I made up for this video called ABC Company, and hopefully it'll make things a little bit more clear. So let's say you want to purchase a call option on ABC Company because you believe the stock price is going to go up a lot within the next month. The current stock price for ABC Company is $50, so you decide you're going to purchase a call option with a strike price of $55 per share, and you pay a premium of $5 for it. Now remember that this controls 100 shares, so you're actually going to pay $500 for that call option. And the expiry date is going to be 1 month from today. So let's say that 10 days later the stock price jumps to $75 per share. Now, since your strike price is $55, the intrinsic value of that option is going to be $20. And for the purposes of this video, we'll say the time value has been cut in half, but it's a little bit hard to calculate because, as I showed earlier, the amount that the time value goes down actually increases as it gets closer to the expiry date. So we'll say it's worth $2.50. So that makes the total option value at that time 10 days later equal to $22.50. So now remember that this is based on 100 shares. So if you decide you're going to sell the option at that time, you're going to receive $2,250. So you can see that that's quite a bit more than the $500 you paid for the option. And you can see the power of options trading and how quickly it can make you a fairly large amount of money with a fairly low amount of investment as compared to buying the stock outright. Just wanted to do a second quick example to show kind of what a brokerage account for purchasing options would look like. This is my brokerage account, so yours obviously might look a little bit different, but the terminology should be the same. The reason I wanted to show this is there's some things on here that we didn't go over that you may find confusing if you haven't seen it before. So the first thing I want to go over is this action drop down here, which will show buy to open, buy to close, sell to open, and sell to close. So if you're buying a call option, you would do buy to open. If you're buying a put option, you would do sell to open. And if you're selling a call option, you would do sell to close. And if you're selling a put option, you would do buy to close. just so you're familiar with that terminology. Over on the right there, you'll see a menu option called View Full Chain, and if you click that after you've selected your symbol, which is the ticker symbol for the stock that you're interested in, it will show you the full chain of all the call and put options that are available and the strike prices and expiry dates. So you can pick an option a little bit easier that way. And of course you've got all the information for entering your option, expiry date, strike price, option type being either call or put, and the amount of options you want to purchase. And then there at the bottom you have your limit and market. So your limit is if you want to purchase an option at a specific price, and market is just buying it at whatever the cheapest current market price is. And finally at the bottom you have the order expiry, so either it's good for the day or good through a specific time period, whatever you set, and then if it passes that time period without purchasing, it'll just cancel the order for you. So hopefully that helps a little bit. So I wanted to end this video talking about some advantages and disadvantages of options trading. So the first advantage would be that you don't ever really have to buy the stock itself, so there's a lot less investment up front with options trading. The premium to purchase an option is always going to be much less than purchasing the stock itself, so you don't have to have as much money to do it. The second advantage is that it's potentially a lot more reward, as we saw with the example that we went over for the sample options trade. You can make quite a lot of money for a relatively small investment if things go your way. As for the disadvantage, there's basically one big disadvantage, and that's the fact that options have an expiry date, which makes them inherently a lot more risky than stocks. For instance, with stocks, if the price goes against you, you can simply hold the stock until that changes, but with options, because they have that expiry date, you may not be able to do that. And then if the option does expire and you're not in the money, it becomes worthless and you lose all your money you put into that investment. So that's going to be the video for today, everyone. I hope you found it useful. If you found this video to be too long, please comment and let me know down below, and I might consider cutting videos like these into 2 parts rather than one long one. If you found this useful, then please give the video a like and consider subscribing, because I'll be making many more videos like this in the future. See you in the next video.